The system for total control isn't a future theory. It is a legal reality being constructed under our feet right now. We have entered a critical 2-year window where the digital gate is closing, and the transition from private ownership to a permission-based existence is being codified into law. When they say you will own nothing by 2030, they are describing a system where your home, your car, and even your parental rights are treated as digital entries on a centralized ledger that can be modified, frozen, or deleted in an instant. This is a financial coup, plain and simple. Not a conspiracy, not a theory. A restructuring of property rights that transfers ultimate control from individuals to institutions, using the legal fiction that a controllable electronic record is equivalent to actual ownership. The primary tool for this is the update to the Uniform Commercial Code, specifically Article 12. As of March 2026, 33 states have adopted these amendments. They create a new legal category called controllable electronic records, CERs, which reclassifies how digital assets can be controlled by lenders and institutions. Here's what this means in practical terms. Under the old UCC, you perfected a security interest by filing a financing statement. Under Article 12, control now determines priority. The party who achieves control through the electronic system, not the person holding the title, gets first legal claim. This works in tandem with the tokenization of real-world assets. Once your physical property is tied to a digital token, it becomes programmable. This means your ability to use what you own can be restricted based on social credit scores, carbon footprints, or compliance with shifting mandates. The car doesn't start. The house doesn't unlock. The account doesn't open, not because a court ordered it, but because the code says so. The current legislative bans on CBDCs often act as a sleight of hand. In March 2026, the Senate passed the 21st Century Road to Housing Act, which includes a ban on retail CBDCs until December 31st, 2030. It passed 89-10. Sounds like a win, right? It's not. It's a placeholder that allows the wholesale infrastructure, the pipes, to be perfected by private banking interests in the meantime. The Fed is barred from issuing a retail digital dollar, but nothing stops them from building the architecture with private partners. Come January 1st, 2031, the system goes live overnight. The ban is temporary, the infrastructure is permanent. Meanwhile, the SEC and CFTC issued a joint interpretive release on March 17, 2026, establishing a 5-category token taxonomy that formally recognizes most crypto assets as commodities rather than securities. This isn't consumer protection, it's market structure preparation. They're harmonizing the rules so that when your house, your car, your business gets tokenized, the legal framework is already settled. The asset becomes a digital commodity on a ledger, and your use rights become conditional on network consensus. This is already affecting Americans. Financial institutions are using algorithmic monitoring to close accounts based on risk factors that include political speech, business sector, and social affiliations. Florida passed House Bill 989 in 2024, amended in 2025, specifically to combat debanking, the practice of cutting off customers based on non-quantitative, non-risk-based standards, including political beliefs. That law exists because the problem is real and happening now. Banks filed over 1.8 million suspicious activity reports in recent years, most generated by algorithms, not human investigators. Your account gets flagged, frozen, closed. No explanation, no recourse, no due process. The mechanism is straightforward. Separate the beneficial ownership from the legal control. Article 12 provides the legal plumbing. Tokenization provides the technical rails. Programmable conditions provide the enforcement mechanism. The result is a system where you may hold the title to an asset, but the institution controls the record that makes it function. They don't need to seize your house. They just need to revoke your access credentials. They don't need to repossess your car. They just need to disable the digital key. This is happening now in pilot programs. It will be standard by 2030. We have at most 24 months to establish exit ramps. Here's what that actually looks like. Specific, legal, actionable moves. Maybe consider moving your wealth out of paper and into a tangible reality. Not symbolic ownership, physical possession. This means local food networks you can walk to, not investing. Physical gold and silver held in your possession or in private vaults outside the banking system, not ETFs or certificates. Hard assets held outside the centralized banking grid entirely. Restructure legal ownership to break the digital chain. If your home, vehicles, and significant assets are held in your personal name, they are visible, attachable, and controllable through the financial surveillance grid. Consider transferring primary residences into qualified personal residence trusts or limited liability companies registered in states with strong asset protection laws. For vehicles and equipment, title them to business entities with layered ownership structures. Operating companies owned by holding companies, with the holding company domiciled in Wyoming, Nevada, or South Dakota. These states do not require member names on public filings and do not automatically share ownership data with federal databases. The goal is to break the direct link between your personal identity and the asset record. Secure state-level legal standing. Florida's debanking protections are now law. Other states are following. If you can relocate your business registration, your banking relationships, or your physical presence to jurisdictions with explicit statutory protections against financial discrimination, do it. The legal framework varies dramatically by state. In a federalized system, state law is your first line of defense. Build parallel economies that do not require a digital ID to function. This means cash transactions under reporting thresholds, barter networks with trusted parties, local currency systems, or silver rounds for community exchange, private lending circles outside the banking system. Every transaction you conduct without a digital footprint is a transaction they cannot monitor, score, or restrict. Eliminate single points of failure in your financial architecture. Multiple banking relationships across different institutions. Credit unions, not just national banks. Physical cash reserves, enough to cover essential expenses for 90 days minimum. Hard assets that function without network connectivity. If the digital system hiccups, freezes, or locks you out, you need operational continuity. Secure your communications and data outside the surveillance grid. Encrypted messaging for business and personal coordination. Hardware wallets for any digital assets you do hold. Paper records of titles, deeds, and essential documents in fireproof storage. If the electronic record becomes the only record, you have no record when they modify it. The gate is closing, but it isn't locked yet. The legal infrastructure is being laid. The technical systems are being tested. The behavioral conditioning is ongoing. Convenience in exchange for control, speed in exchange for surveillance, and security in exchange for sovereignty. You have 2 years, maybe less, before the transition from opt-out to opt-in becomes opt-out to locked out. The system clicks into place not with an announcement, but with a software, a terms of service change, a new security feature that requires biometric verification for every transaction. Now is the time to secure your sovereignty before the illusion of choice disappears forever. Not by fighting the system they're building. That's a losing battle with a captured legislature. By building structures they cannot reach, relationships they cannot monitor, and assets they cannot freeze. The coup succeeds when you have nowhere else to go. Build somewhere else to go. Until next time.